Greetings, everybody. This is Christopher Messina coming at you from the Messy Time Studios, broadcasting as ever from the beaches of the last free state in America, Florida. Joining me virtually from London is Richard Johnson, the CEO of Texture Capital. I'm just going to kick it off from there. Richard, how you been?
I'm good. I'm actually coming at you from London via Brooklyn, but close enough.
Close enough. Fair enough. Oh, fair enough. Anyway, a little bit closer. Your visa's working now? It's good. So
They let me back in.
they let
Yeah.
you back in. That's well, then that's not fair because they keep your Majesty's government keeps kicking me off at the border. Um, what's top of mind today? What's the kind of most interesting stuff you're seeing at the convergence of kind of crypto, tokenization, financial markets? What's leaping out at you the most?
Yeah, I mean that's what I do. For your listeners, I'm a finance executive who moved into the digital asset space. We met back in the TradFi days, as they say. So now I'm looking to bring blockchain technology to traditional capital markets, leveraging the powers of decentralization, smart contracts, and transparency in a lot of the asset classes that the institutional investors play in. So it's a pretty hot topic. I mean, I think a lot of people, it kind of comes and goes with the cycle. A lot of people are looking at the crypto price right now. We just hit 44,000 on Bitcoin, but we're not really a crypto player. I'm happy to chat with you about that. Like I said, we're really focusing on using the technology for private equity, private credit.
That's a good spot, right? Because most people hear blockchain and either they're familiar with distributed ledger technology and they're familiar with what it can do, or they hear Bitcoin and that's absurd because it was like 8 cents that you could buy a pizza with it, and now you can buy a Ferrari, and soon I can't buy a Subaru. So, what's the difference between Bitcoin as BTC, not BSV, BTC, from how you see it, as opposed to kind of the stuff you're doing around smart contracts and using blockchain more generally?
Yeah, well, Bitcoin is built on blockchain. That was one of the key innovations in Satoshi Nakamoto's white paper. Blockchain is a decentralized, distributed database where every participant on the network has a copy and is able to read on that network and is also able to write on it. He combined that some very complicated cryptography that enables, essentially what it enables you to do is it enables transfer of value. So what you can do with Bitcoin is it enables anyone to send Bitcoin to anyone else anywhere in the world. It settles in about 10 minutes, no intermediaries. It's all settled across this decentralized network. I often term it it's about transfer of value. And coming from the capital market space, that's what capital markets is as well. It's about transfer of value from one person to another.
Right.
What we have in capital markets, when you do a trade with, E-Trade or whatever, they have their own internal databases where they're recording who owns the securities. That's kind of called in street name. And then you have this central counterparty called the DTCC, and they're helping match up trades at the end of the day. And then you have every other broker on the street has all these kind of centralized silo databases. So part of the allure is like, listen, if everyone's looking at the same database at the same time, we can be much more efficient that way. The settlement time I mentioned previously was kind of 10 minutes for Bitcoin. It's even faster for some of the new proof of stake blockchains. Settlement timing in equities, public equities, about 2 days. It's pretty good, really. But what you can get to in capital markets is what we call atomic settlement. Nothing to do with atoms, really, but it essentially means like instantaneous settlement of the cash instrument versus the investment asset. The trade is basically the settlement. So I think that's kind of the holy grail for the folks like us working in the tokenization space.
And I'll break in for those because a lot of my listeners are not capital markets experts whatsoever. Yeah. So part of what Richard's referring to would be that batch settlement is what has traditionally happened on Wall Street. Goldman Sachs does 6,000 trades a day through the New York Stock Exchange or whatever the number is against all these different counterparties that will all send in their data at the same time, and then the clearinghouse, whether DTCC or New York Stock Exchange clearinghouse, they at the end of the day will do a batch. They'll take all those trades together. They'll make sure they all match up perfectly, and when they don't, there are breaks, and they fix those errors later. But this is, rather than waiting for that entire set of trades to be done during the day, it's just as it gets done, that's atomic settlement, right? We just do it, it's done, don't think about it anymore. And done correctly, that makes the markets a whole lot more efficient.
Yeah, there's a huge opportunity there because if you think about what's happening when it's taking days to settle, there's money stuck in the financial system. So you've got billions of dollars per day. It's taking 2 days to settle for some asset classes, weeks for some other asset classes. That money is just sitting there. There's a cost of capital. It's pretty high right now at 5%.
Right.
Uh,
So the
so,
intermediaries, let's be clear, someone's making money on that. The
oh yeah.
clearinghouses are earning money on the float, so they love the current system. This idea of instantaneous settlements not so hot for some of those people.
I know it's always like that when you send a payment from your bank account, it leaves that second you hit OK. It
Right.
doesn't get to the recipient for like 3 days.
Yeah, kind of amazing. Yeah,
Yeah,
so when you think about that, all that money sloshing around in those intermediary accounts, kind of like for those who are religiously inclined for the medieval church, it's kind of like purgatory. Capital sits not quite in heaven, not quite in hell.
Yeah.
We're going to decide. But that's cool. And so, how many years ago do you set up Texture now? It's been what, 5 years, 6 years?
2019, yeah, pretty much getting on 5 years. Yeah, spent 2 years of that talking to our friends at the SEC and FINRA, who are the financial regulators.
My condolences. They're great folks. They're great folks.
Going to them saying, "Hey, we want to use blockchain in capital markets." In 2019, right after the ICOs blew up.
Right. Did they just lock the doors in Washington?
They're a bit skeptical, which honestly they shouldn't have been, because what we're trying to use it the right way. And in fact, my motivation for setting up the company was something Jay Clayton said when he was chairman of the SEC. He said that every ICO I've seen as a security, and these platforms need to be regulated.
Right.
And to a large extent, I agreed with him, and that's why I set up Texture Capital, my company.
That's excellent. That's great. And so it's been a success. How many of these transactions have you done over the years, and are you getting kind of more and more momentum as people get comfortable?
Yeah, so we've done probably what we call kind of security token offerings is, I guess, one word, or digital securities offerings. We've done about a dozen of those we've been working on. We also have an ATS, or alternative trading system, for secondary trading. We can support institutional clients, high net worth investors, retail investors. We're agnostic to the asset class. What we're doing now actually is kind of cool. We're really trying to help taking our technology and kind of opening up, making more infrastructure, so we can help lots of diverse asset classes come to a more retail market through what's called Reg A offering. I'll give you some examples, actually.
Yeah, that'd be good. That'd be great. So people understand what a Reg A offering is, and kind of what you mean by diversifying at the asset classes that aren't currently traded. That'd be really helpful.
Yeah, so investment options for the average person is basically going to your Schwab account, E-Trade, or Robinhood, or whatever, and getting whatever's in there, which is going to be public equities. And there's about 4,000 or 5,000 options, I think, different stocks out there.
Yep.
But then we always hear in the newspapers or in whatever documentaries on TV and so forth, there's the private equity, there's private credit, there's all these kind of real estate. This is how, of course, the former president and his family made all their money in these real estate transactions, and other areas as well, like fractionalized art, music royalties, all these types of asset classes have been very, very difficult for everyday investors to access. And what we're trying to do is use this technology in combination with certain types of regulations to make it much more easy to kind of create fractional markets, as it were. So investors come in, they can invest like $250, and they can get a stake in some music catalog, or a small stake in a real estate asset, or whatever. So that's actually really probably the most exciting part of what we're doing right now. We're seeing a lot of folks really coming up with these great ideas, and we're not the ones coming up with the ideas for the asset classes, really, which is also kind of what I like. We're just providing the tools for them. So we're providing the infrastructure, and if somebody says, "Hey, I want to bring this," I had a lead come in this week, in fact, very interesting one. They want to enable investors to invest in people in a way. So
there are a lot of really bad jokes sitting there, but I'm going to let those go and let you explain.
Yeah, but could, for example, Harvard graduates, sell off a percentage of their earnings to pay off their college debt or something like that? Would somebody want to invest in them? No, I think there's a lot of hurdles around that, but I think it could be interesting to explore. I think we've seen it done with horse races, race horses, other types of sports events. So a lot of these things I think are opening up. It's going to be interesting.
That's good. I love that. What I found so useful what I found in innovation, I've been blessed to do a lot of innovation in the capital markets over the years with some great teams, which is what usually takes. I've come to live by what I call the law of one new thing, Meaning, if you bring something to market and it's really great, it's really brilliant, but you can't really access it unless you also agree to this other new thing that's really great, the world just stops listening to you. Whether together those things are the best thing ever, my experience has been like trying to sell two new things at once. So you've got the platform that works, right? Basically the trading rails. Then those people who know, say, for example, real estate, fractionalized real estate. What kills me about it is that's so obvious. It should have taken off like gangbusters for years already. Like REITs already exist. There's already a whole idea of a thing that's kind of like share based. But there was one group that set up a real estate fractionalized exchange, and they were just wrong in a couple of things, and it drove me nuts because I spent a lot of time with them to join them to run it, and they chose someone else, and sadly, after years of floundering around, they failed. And like, it kills me because there's no reason it should have failed. They had phenomenal assets. They had the almost right idea. But they were kind of wrong in how they were fractionalizing it. They were kind of wrong in how they were setting up the exchange mechanism. And it's that when real estate fractionalization does take off, it will take off on your platform, it will take off on committed exchanges, most likely. I think those guys are going to look at it and like bang their heads against the wall because it was so obvious and they so had it.
Yeah.
They didn't listen to the market correctly. So your approach, are you finding that is really kind of the best way? Like, hi, we've got a way for you to trade. You come here and you tell us how your product's going to work. Has that been the method of success?
That's what I like about our strategy, and we spent a lot of time, as founders. And I got this pushback all the time from VCs. We can talk about that maybe.
They know nothing.
But they're all, oh wow, you need to choose a vertical. I was like, no, I do not need to choose. I'm not going to choose a vertical. We want to support the entire market is going to tokenize. We want to support all of that, and we're horizontal here, and we're agnostic. I'm not a real estate expert. I'm not going to turn myself into one.
99% of VCs are idiots who couldn't run a company if they tried. The old school fantasy of the founders like Hewlett and Packard, who then had money and then invested, that's long gone. They're the worst. I say that loudly because I'm never going to want money from them.
Yeah, no, I know. Yeah, no, it is. They invest in whatever it is. So they're proud about we invest in 1 out of every 1,000 companies we look at, and also, only 1 out of 10 ever does anything and it ever makes any money. So,
and they also enjoy negative selection. It's a miracle they even spoke to you. They might have mistakenly thought you were 19, because the last thing they ever want to hear from is an experienced executive who's had P&L success. Because no. They want someone they can either shove out the door in 6 months, or if they get lucky, they'll put them on the cover of Wired and say what a genius they are for finding him. They do not want experienced talent walking in the door with pitches.
No, I think there are huge biases within the VC, and I don't think they know about them. Certainly, they're biased towards youth. That's for sure, because who do they get screening all the companies coming in? It's the analysts, right?
Yeah.
And they relate to people their age and so forth, and that goes counter to. There's a study out of Harvard. I've linked it in one of my blogs. I can find it if you want. That said that the most successful founders are 45 when they get started. I was 46 when I found it.
How amazing! You've actually racked up 2 decades of experience of what works and what doesn't, and now you're ready to do the right thing. But my favorite definition of an expert is someone who has made all the possible mistakes in a very narrow field of endeavor. And once you've done that, I mean, I hear it now when people come to me with pitches for how we're going to trade our materials out of our mind, right?
Yeah.
Well, we'll do it in this kind of market. I'm like, that's not going to work. I saw 8 people try that and fail, waste $1 billion. That's not going to work. So there's a lot to be said for what you didn't get right, or what you were at least there for that you didn't get right. But you got off and running and moving. VCs be damned. And how big is the team now?
We just added a couple. It's still pretty small. I think about 10 of us at this point. We added 2 more people recently.
Yeah.
Pretty lean still, but
it's huge. And so with Reggae offering stuff like that, like right now, if a listener hearing this, like, that sounds really interesting. How do I get involved? Do you go to texture.capital and see if they can log on or create an account, or how do they do it?
Yeah, reggae offerings have nothing to do with music from the West Indies. It sometimes gets
very nice.
Actually, very interesting, I think. And there is a blog on our website on, they're both kind of forms of crowdfunding that came out of the Jobs Act. So the Jobs Act was something that Obama signed into law. It stands for Jumpstart Up. It's very kind of tautological. Jumpstart Our Business Startups. And they wanted to, capital dried up after the financial crisis of 2008. And there's a big concern that how a company's going to get funding, and you turn the engine of the American economy and so forth. So they came up with this law. Of course, it took them like 4 years to get it through Congress. So by that time, we're kind of okay anyway.
Right.
But it does allow companies to raise capital from retail investors in a very regulated and structured way. So I think it's great for companies. They can access, like if you're a company with 100,000 or whatever, or 50,000 monthly visitors a month to your website, and they like your product and whatever, turn your customers into investors. You can turn your investors into customers. You can bypass the VCs at that point as well, potentially. So there's two rules. Reg CF stands for crowdfunding. It's smaller. You can raise up to $5 million per year. And then Reg A, a bit of a more arduous process. You got to go run it by the SEC, but you can raise up to 75 million. And then like 75 million is a lot of money for a startup.
Oh, absolutely. Yeah. I mean, a lot of good startups can go long distances on a couple of $1 million. That's great. And what's the kind of average size of offering that you're seeing going onto your platform?
I'd say the average is probably around 40 million, something like that.
That's great.
Yeah.
Is it biased towards one industry and another? Is it more tech heavy?
It is a lot of real estate, I got to say. It happens to be probably 40% of my pipeline.
It makes sense, right? You're going to do it right, and you're going to find that market correctly, and there's going to be, well, it's a question. I mean, I knew I was trying to help these guys figure out a liquidity plan and a market making plan. Do you have active market makers in that sense on your market yet, or is that to come potentially?
To come, yeah, they'll be there. I think that market makers love them. They'll yeah, even if the spreads are kind of wide initially, if there's money to be made, they'll come into space. So
we love widespread. Best thing ever.
I know, right? But that's even the spreads are wide. There's still a value for investors. I mean,
of course, you got someone to take the other side.
Yeah, they can do high frequency trading for a fraction of a basis point and do it whatever it is 1 million times a day, or less frequent, but spreads of whatever it is, 1 or 2%. They're still providing value to some of these markets potentially.
They do. I remember I was, for my sins, dragooned into helping some regulators and users sort out the headaches of the Dodd-Frank Act, which, as you recall, were myriad and still are. But my favorite was when these clowns decided they're going to regulate, right? They love market making because they were told that sounds good. Like a congressman's been told that a market maker stands there to buy or sell a share of stock from his or her constituent. That sounds great. But they get very nervous about proprietary trading, which sounds like you can make an evil profit off of doing that. And that sounds bad. So how do we allow market making without letting them make profits on proprietary trading? And in only the way that Congress could. They came up with like this 17-point test as to whether market making was proprietary trading or not. It was absurd, absolutely absurd. Eventually they ditched some of that nonsense, but
I managed to avoid most of the Dodd-Frank Act because so much of it was in the kind of the swap space and I was more kind of cash equities. But so market makers, the official term market maker perhaps used to come with it, like they would have privileges and also responsibilities.
Yep. Right.
And the responsibilities were, you got to make a market, you got to make a two-sided market, all day long.
You have to be there 85% of the time. You can't walk away when markets get volatile. All those things.
Yeah, and the what you had to do in turn, what you got in return for that was some kind of exclusivity of some kind. If you look at the specialists, they got all the flow on the exchange, as it were. And what turned out is that people hated the fact they got this exclusivity around flow or whatever it was. Didn't really think about, well, they are there, on bad days as well. When you need them, they're picking up the phone, the electronic phone.
They only watch the easy days where it looks like, well, he's just getting an extra penny per trade because he sees the deal flow 8 seconds before I do. That's not fair.
Yeah. So I think the market is characterized by more of what I would call proprietary traders than
Yeah.
actual, old-fashioned market
Right.
makers, which is
Right.
fine.
No, that is perfectly fine. In large measure, that will eventually turn out to be a more robust market full of natural liquidity. Because
Yeah, I mean, you get the
even though they
flash.
had obligations, right? When things get really bad, they're like, I'm not trading this market. They can find me later, right? Like,
Yeah, well, then you get a flash crash, which is, I
right.
guess, the downside. But
Yeah.
now, but then oh, okay, so something broke there. Let's fix it. They put in these market-wide circuit breakers and things like that. So we haven't had another bad one
Yeah.
since that.
Now, for where you are, as people will understand this, they think about how markets develop. In the early days, when there's not a lot of product, there's not a lot of participants, it's what we call trade by appointment, right? There may be 10 or whatever number of trades per day. Are you still in the early stages where most of your flow and most of your revenue comes from origination, or are you starting to get to the point where there's more secondary activity turning it into
No, you're dead right. It's all origination at this point, nearly all
right?
origination. We got to get the assets on chain,
Right.
and then we can trade them basically.
That's basically it. And do you have a target date for when you'd say to people like we're really trying to push and make this a secondary market, or you kind of letting that be more organic?
Yeah, so the marketplace strategy we have, where we're looking to bring kind of multiple assets live at one go, whether it's for real estate or renewable energies or whatever, we've got our first decent sized client going live in Q1 on that.
That's awesome. That's
Yeah.
huge. Huh. And so what do you see as, is there a big competitive landscape for what you're doing? Are there lots of other people in your space? Or are you still pretty much out at the forefront?
It's not that big, which I'm okay with. I think if you look at FINRA's website, they talk about how many broker dealers have been approved for digital asset securities and so forth. They say the numbers, I think, it's either 7 or 9 who do both primary and secondary trading. So we're one of those 7 or 9,
Right.
which is a great space to be in.
And that's a separate category then. You could be an equity ATS, of which there are like 40, but that's different. They'd have to apply to become a digital assets ATS also.
It's separate, yeah. Funny if I looked it up. It's the non-digital ATS is up to 71 now.
I can totally believe that. It's it's also just a regulatory fluke of how they have, because I've set up ATSs, God save me, and I've helped other people buy them. And one of the things that turns out to be a major headache, which again, hello FINRA, guys, pay attention, is that you might as well just set up a new one. There are all these shells sitting there. So logic in a rational market would be, I need an ATS, you, person X or company X, have a defunct one that's sitting there. It's just cheaper just to keep it going in a weird way. But if I go buy it, I have to go through the whole 6-month process anyway that I have to go through to apply for a broker dealer. And I inherit all of its hidden liabilities. What in practice that means, right, is you could ask around, your lawyers could check, there's no litigation, everything's fine. And the day you buy it, you get sued because unbeknownst to you, a trading assistant at the defunct company has been harboring a grudge and a sexual harassment suit against the former principals. And now he or she brings it. And is allowed to bring it against you, even though you got nothing to do with it, but you're the regulated entity. And it's a flaw in the regulatory structure that they don't provide sort of a bankruptcy restructuring for the ATSs, so that doesn't happen. But once you find that out, it's a known liability. Why would anyone ever bother to buy an ATS after that? And they haven't, because of that. It's a radical market inefficiency.
Yeah, I mean, you do see it happen. That is a concern. I think that things can come back to bite you. I mean, the key is, I mean, keep it clean and keep it. I mean, yeah. Smaller firms are going to be okay with that, I think. But yeah, no, I hear what you're saying.
Yeah.
But then again, if you're looking at the digital space, it's not 6 months to get a new broker dealer. It's generally more, like I said, a year and a half to 2 years on that. So that goes into the formula there.
Right. Which about fits the government's understanding of fast-moving innovation. So that's pretty exciting. How many people do you think looked at this and decided, "Ooh, I'm going to set my thing up in Gibraltar or the Bahamas"? Well, that's a bad example with FTX, but I'm going to set it up.
No, it's a perfect example.
Yeah.
FTX, he set up in the Bahamas and Hong Kong specifically to avoid US regulations.
Yeah. It gives regulation dodging a bad name, because they're facetiousness aside, they're often good reasons. Like you got a bunch of mainly sophisticated investors who aren't stressed out and don't need the protections of the SEC looking out for them. That is just a delay, right? So it's always a balancing act. But you guys did the right thing. You went the hard yards through it, so now you're in a good position.
Yeah, I feel that way.
That's awesome. So
Yeah.
what sort of in the thought of that, as you're creating and as you guys have been developing the business and reacting, of course, to what you're already doing, are there sort of surprises that have occurred to you that you didn't expect when you started this out, or has it kind of gone the way you thought it would?
I guess I would say I'd have thought that regulators would be more open to using this technology, frankly.
Huh.
They're just not. There's a key use case we talked about. I don't even bother talking about it anymore. I bring it up every now and then. But when you think about what regulators want to do, they want to regulate markets. They're supposed to support capital formation and fair and orderly markets. They're kind of the two tenets of the SEC. And innovation is a part of that. So at the beginning of this conversation, I was talking about how you have this distributed ledger, which is a complete record of securities ownership and transaction history, which is a blockchain
Yep.
basically. And then you look at kind of capital markets. There's something called a consolidated audit trail, which they spent years and years building. I'm not even sure if it works right now.
Boondoggle.
And
Three
there's a
different tech
huge
providers, hundreds of millions wasted.
yeah, exactly. And there's a huge opportunity for a regulator just to plug in and operate a node on the blockchain and kind of seal that activity. And you can do it in a kind of a, you can have transaction confidentiality and things like that. There are ways to do this where they could actually say, roll up their sleeves, like, okay, let's get on with this. We have some concerns about this, but we like you guys. You came in, you registered, you got a clean record. We'll work with you. And it could be us. It could be there's plenty of firms like us out there.
Yep.
And we're gonna use this technology so we can see if we can do a better job of monitoring the markets, which is a big part of what they're supposed to be doing. I don't see any of that.
That's it. Wow, that's so interesting. Yeah. So I know when I went and spoke to the SEC about a great tool we had to improve market making, I went in to have a meeting with like 2 or 3 people, and they'd had a week to prepare. So I was in DC and I went in, and they booked out like a conference hall. There were like 40 people sitting there. So luckily I'm nimble enough. I moved from a close intimate setting to a speech, but there's it's fascinating to see. I'm kind of rambling, but dealing with the regulators, well, CFTC and SEC, I've encountered a lot of really smart folks who want to do the right thing, but they're also kind of incredibly terrified by the asymmetry of the risk reward in government service, right? If they let something go through that's damaging, it's their career and they're splashed on the cover of the Washington Post and it's all bad. But if they let things go through and they all work perfectly, they don't get any particular acclaim. So it's a tough balancing act for them, I think. But that surprised me that your process was like a year and a half. I mean, to get a broker dealer up is 6 months. What are the extra things they did that made that so long?
They they just spent a long time on it. We had 14 extensions in our application. I think they counted.
Gosh.
And I think they were a part of it. It just took a long time. All the timelines just dragged out.
Right. Not fair enough.
Yeah.
Any advice for anyone who wants to come compete with you? You're going to tell them not to bother. It's horrible, really difficult. SEC is impossible.
If there's anyone who wants to come and who wants to launch a tokenized marketplace for any type of digital securities, I tell them to save their time and come to us, and we'll work out a partnership deal.
Much better idea. No, and a smart one too. And have you done any of those yet? I mean, that would seem to be the natural extension.
Yeah, absolutely. That's kind of what I'm talking about. We're doing a bunch of those right now. That's a big part of our strategy. Yeah. Yeah.
That's great. So they'll kind of white label texture and they'll run their own market and you just run the innards for them. Oh, that's awesome.
Exactly.
Anything else that's really important, top of mind? You want to tell the people who you voting for next cycle?
Well, I'm not a citizen, so I don't vote.
Lucky you.
Makes it. I guess it makes it easy for me. I don't have to.
Those old jokes about the devil and angel on the shoulder. The last few elections, it felt like a green-colored devil and a red-colored devil. They're both screaming nonsense at you. You're not sure what to do.
Yeah, no, yeah. I mean, the politics is I mean, we can tie that back, I suppose, to the prior conversation. I think it's like one of the weird things is, or maybe it's not weird, is that you've got things that shouldn't be partisan are partisan. And everything's partisan right now. So crypto is partisan, right? Which is, which it shouldn't be. I mean, it's just a technology, right? But you have Republicans supporting it in general and Democrats not supporting it in general.
And what are the arguments they give for that? I try to pay no attention. So.
Well, it's Elizabeth Warren saying that it's only for criminals and stuff like that.
Well, she'd know. Sorry. I said that, not him. The host said that.
I mean, a lot of that, I'm not the first person to say this. A lot of the kind of stories that I've heard is that Gary Gensler is a political animal, really, and he really wanted to be Treasury Secretary. He didn't get that job, and they put him in the SEC. And the rumor is that Elizabeth Warren would said that she would support. She'd scratch his back if he scratches hers, essentially. So he may still be gunning for Treasury Secretary, and the senator from Boston may support him in that. I don't know if it's ever going to happen, but that's the story. It's all kind of the machine. There was the swamp over there where it's all about
When I look at her, I just wonder how many years of empirical data does she need to prove to herself that all of her policy instincts are wrong? I mean, it's a good question. Right? She was the biggest cheerleader for Dodd-Frank, for Obamacare, and in a ice cream sundae made of irony with joy on top was her having hearings last week to bitch about the predictable outcomes of Obamacare. It's awesome. She's screaming at these companies for making all this money because Obamacare was working exactly as it was designed to do, and she cheered for. And now she's in an outrage because costs have risen. So anyway, that's aside from your business. But is there some impact of not necessarily her, but that sort of political drive in DC? Are you feeling any of the impacts for that practically, or is it really just something on your horizon?
No, I think we do. I think we all do. I think there's the SEC chairman has been very much like, we don't need any new regulations. People just need to follow the new regulations. And listen, I'm one of the people who eschewed the raw crypto space. We went in and regulated. We want to use in capital markets. I've got 20-year history. My co-founders have. We've got my CTOs named inventor on like 6 or 7 ATS patents out there. Yep. We want to help markets here. Throw us a bone. We could certainly have just a more reasonable conversation instead of somebody saying black and somebody else saying white.
Right.
Or what PC thing.
That would be, broadly speaking, a delightful, nuanced conversation in the swamp that is full of black and white arrows being shot at each other. That's not because we're talking about Elizabeth Warren. Any final thoughts, or is there anything that I should be paying attention to that I'm not paying attention to?
I'll change topic on you on something. If I'm just sitting there looking at the palm trees outside your window, and we were talking about real estate. There's a massive. I'm sure you have an opinion on this. There's a massive real estate shortage in this country. I think we know that we need to build more homes. A lot of people I talk to are looking at Florida, but the problem there is you can't get your house insured. All the insurance companies have jacked up rates. They lost money, so they're socializing it. I realized this because my insurance company here, I live in Brooklyn, they increased rates saying, oh, well, you're within 5 miles of the coast, so there's a hurricane risk.
Fabulous. That's fabulous.
So
that's every time Ronald Reagan had some of the best speech writers ever. Hi, I'm from the government. I'm here to help you. It's an agony. Like, so there's still a booming price market down here because you're saving money leaving. I left Manhattan to Florida. I made 14% just moving. It's a good hedge fund return, right? But then you get down here and other things are more expensive. Car insurance, because it wasn't until recently DeSantis finally changed this. It was like the jackpot lottery state of the union. So this is where all the ambulance chasers come. Did you trip when you were on at the salad bar at Ruby Tuesdays? You need $90 million and we'll get it for you. So car insurance is psychotically expensive, and then either you pay cash for your home, or or if you're borrowing for your mortgage, they force you to buy hurricane insurance. It's getting to the point where it's literally about to be it's gonna get a locked market. I was just talking to someone the other day. Has got, like, what's he paying? Something like $22,000 a year in hurricane insurance. That's with a $75,000 deductible. So since a new roof on the house of his size is 65,000, he's like, what am I insuring? Like, the main problem in a hurricane is your roof comes off if it wasn't constructed properly. I'm going to pay for that anyway, but my bank is, so it's like my entire life is focused on paying off this mortgage, so I don't have to pay it anymore. So it's a tricky thing, but it's gonna prove to be a damper on prices, I think.
You know how many houses have been destroyed by hurricanes in the last 10 years or 20 years in New York City? None. There was some, yes, sadly.
Yeah, we lived through Sandra was the last one before we left, and all it did was knock the power out in our building. We had to go up and down 26 flights of stairs. Great exercise.
Yeah, for sure. And there's flooding and so forth, but it wasn't like, oh, we've got to rebuild blocks of houses here or whatever necessarily. So I think there's actually an opportunity for something like, you look at the insurance company. There's how many are there? I don't know, 20 big ones out there. To kind of make, is there a way to use blockchain to decentralize that as well? And what I'm talking about here is, have a kind of a network where people can insure each other. A lot of companies do that in health insurance because they got whatever 300 employees, or if you got more than 300 employees or 400 employees, you're kind of socializing the cost within that company anyway, and you're just using the framework of the insurance company for the health insurance. Why not do something similar but with blockchain, so that we can all kind of put our money in and put it into a smart contract, and then if there's a catastrophic event, the smart contract pays out. I think there's some opportunities there.
We looked at it. It's funny, in terms of Florida real estate, we looked at it at replacing, setting up a new mortgage company for Florida real estate specifically, or people in hurricane zones, to arbitrage this opportunity, because mortgages right now are not general obligation in the US. They are against the asset, right? Well, if you switch that, and I say to you, okay, I'm not gonna force you to get hurricane insurance, but in essence, it's your ass on the line now. The mortgage is general obligation, so you are going to pay for it. Which exposure do you want? And most people who are buying a middle-class home and above will logically choose, well, I'll take the general obligation then, because I'm gonna pay for all this, and a hurricane might come every 20 years that takes my roof off. So that's 440 grand out the door principal before I pay for a $65,000 roof. Yeah, I'd much rather take the general obligation. And the headache we found is, of course, in America, because so much of this has been rigged by the government in one market, skewed the way they want it, all of those general obligation mortgages would be non-conforming, so Fannie and Freddie can't buy them from you.
Yeah.
So definitely. That's possible, right? But it's another wrinkle. So now you've got to really build up a much larger pool of capital, because you can't package the mortgages easily. But once again, I'm for the government. I'm here to help. But Richard, thank you. I appreciate you taking the time to come on. I'll put the link to Texture below for anyone who's interested to learn more. Final words of wisdom?
Yeah, no, that's it. Great chatting with you. Good to see you on the screen here, and keep up the good work.
That's awesome. And for my usual listeners, I will close as always. Please turn off the mainstream media who are lying to you and tune into messy times. Thanks a lot.